My personal style of investing involves investing in companies that appear to be turnaround plays, and one of my biggest investments is in Alibaba. Alibaba is a stock that over the course of the last 5 years has fallen by over 50%, and this has a lot to do with regulatory pressures that have been put against the company, as well as pressures of potentially being delisted from the US. However, more recently, some of these regulatory concerns are starting to fall away. And on top of that, super investors are now going more heavily into Chinese companies as the sector appears to be more safe than previously thought. So in today's video, we're going to discuss the turnaround of Alibaba and how it could be sooner than people think. So if you enjoyed the video, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. There are multiple reasons why Alibaba's stock price has fallen so much over the course of the last 5 years. But one of the biggest reasons is the clampdown from China on their big tech industry. We have seen them deal out a number of fines to companies throughout the country, and this includes Alibaba. They were specifically fined $2.8 billion for breaking anti-monopoly laws. And this fine is probably justified because during this time period, Alibaba was forcing merchants to choose between one of two major platforms in the country. And this really caused a lot of these people to gravitate towards Alibaba just because it was the larger of the two platforms. And this helped them gain a competitive advantage. However, since then, they have pulled back on this policy to try and get around some of these laws and regulations and prevent them from getting fined further. On Friday, August 30th, China's State Administration for Market Regulation said that over the past few years, it has been supervising Alibaba's process to become compliant with antitrust regulations, and this rectification work has achieved good results. And this is a great result for Alibaba because this likely means that there are no more fines coming down the pipeline for the company. And overall, this should be a good sign for investors because it shows a pulling back of regulations from China against a lot of these bigger tech companies throughout the country. And right now, China is not in a place to really put more regulations in place. The economy is in a tough spot, and they need to be promoting a lot of these larger businesses to increase hiring and increase economic activity throughout the country. And overall, the market saw this announcement from the Chinese government and took it in a very positive light, as Alibaba is up around 5% over the course of the last couple of days. And this move from the Chinese government could actually make the country's companies appear to be more investable, as there's less regulation and concern that the Chinese government could really just clamp down on these bigger businesses. One of the biggest investors in China recently has been Michael Burry. He added 24% to his position in Alibaba and also has positions in other Chinese companies like Baidu and JD. One of the other main super investors who is an investor in Alibaba is David Tepper. David Tepper is most well known for being the owner of the NFL football team, the Carolina Panthers. However, his largest stock holding is Alibaba. He did make a reduction this most recent quarter of about 6.6% of the position. However, it is still his largest position, and if you look across his top 10 holdings, he made reductions across the board. This is likely him stacking cash because he's a little bit concerned with valuations in the broader market. However, David Tepper made these moves prior to knowing that the Fed would be looking to lower interest rates. More recently, we have seen the Fed come out and announce that they are going to pivot their position on interest rates. And what this means is they are going to be looking to cut some of these rates down, and ultimately this has a big effect on the stock market because oftentimes when rates are lower, valuations tend to be higher. And that could help a lot of these larger tech companies because they already have inflated valuations. So if we see interest rates drop, we could actually see some of those valuations be commanded and actually see more growth in these companies. However, in the short term, I expect there to actually be a rotation of money from these larger tech companies into some smaller companies. This doesn't necessarily mean that those big tech companies are going to go down by a significant amount, but I think there could be more cash going into smaller companies. We saw this happen in 2020 and 2021. Even Alibaba is a good example of it because if we look at 2019 through till 2020, the stock went up by over 70% and reached an all-time high of $310. Obviously, there was a lot of regulatory pressures and delisting concerns that drove the company down after that. However, it peaking out here is very similar to what we've seen with a lot of other spec stocks in the market. Some of the more famous examples of these spec stocks that saw big run run-ups in 2021 are companies like Palantir. Palantir IPO'd around $10 and almost immediately ran up over 250% to a price of $35 per share. And it's taken a long time for it to get back to even close to that price. Another good example of this is Hood, which IPO'd in that 2021 timeframe around $35 per share. It ran up immediately to $55 per share, however, is down over 60% since then. And one of the best examples of what lower interest rates and higher valuations can do to the market is through looking at IPOs by year. This is over the last 24 years. And what we see in 2020 and 2021 is there were significantly more IPOs in those years. We had 480 in 2020 and then 1,035 in 2021. That is way above the average. And more recently, we're well below 200 IPOs per year. In 2024, we have only seen 129. However, if we start seeing interest rates lower, we could potentially see IPOs go up. And this often occurs because companies want to get the most amount of money from their IPOs. So when valuations are high, interest rates are low, a lot of these companies look to IPO to get the bag from offering their company on the public markets. So I don't think that IPOs will get back into the range of 500 to 1,000 per year, but I do think they'll get back into that maybe 200 to 250 range. And that seems a lot more healthy for the market and will introduce a lot more capital into the market to impact companies like Alibaba. But the other big factor with all of this is the valuations around big tech. Right now, Nvidia has a forward P ratio of a 42.55. Netflix is sitting at a forward P ratio of a 37.31. Amazon has a forward P ratio of a 38.61, while companies throughout China are trading at forward P ratios under 10. Alibaba's current P ratio is sitting at a 9.81. And what this ultimately means is there is a lot of money in these big tech companies, and this has driven up valuations. And a lot of these super investors hold big positions in these big tech companies. So over time, as investors get more comfortable with China, I think that we could potentially see some reinvestment into companies throughout the country. And this includes Alibaba. I think we could see them pulling money, adjusting some of their position sizing out of big tech and into other markets. If you scroll through these super investors' portfolios, you'll see that out of their top 5 positions, oftentimes they at least have one, if not 2 or 3 big tech companies. And what that means is as these valuations have gone up, it's harder for these companies to trade in line with the market. If the S&P 500 goes up by 10% over the course of the next year, oftentimes what that means is that these big tech companies need to go up by 10% or even greater. However, with these positions making up more and more of the market, a lot of these super investors are going to have to look for alternative investments, especially in smaller cap companies, to potentially outperform the broader market. And China is one of the best places to get deals right now on companies. We could see that their broader index peaked around 2021 at 4,000 Chinese yen. However, over the course of the last few years, it has been cut by almost half and is currently trading closer to 2,000 Chinese yen. So in my opinion, I think there's a lot of potential upside for Alibaba. I do hold a large position in the stock, so keep that in mind. But I think that a lot of these super investors are going to be looking for places to put their money, as a lot of these large tech companies have very inflated valuations. And one of the lowest valued markets right now is China, despite the potential growth that they have in front of them. And if they start turning around their economy, pulling back on some of the regulations, I think that could have a big impact overall on the Chinese economy and thus the companies throughout that country. But as I always say, don't buy a company just because I talked about it here on YouTube. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. With all of that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, what do you call a fish with 2 knees? Check the comments down below for the answer. Thanks for watching.